Hi everybody, welcome to another update on the stock screener. Today we're going to talk about a diversified energy company. I know nothing about this stock, but let's embark on our journey and see what this is all about. As you can see here, this looks like a newly listed company. It's starting in January, so this is probably not the latest status of this company. And as you can see here, it's also on the UK listing. And on the UK listing, we have a market cap of 470 million currently. And this does have more history behind it. Went up and back down. It's actually down quite a lot, more than 50%, 60%. So what on earth is happening here? Now I opened the financials and saw that this is listed in US dollars, as you can see here. Unless otherwise stated, the financial statements are in US dollars. So I'm going to use US dollars going forward. This was the latest report that I could find. So we take the June report. Since we are going for US dollars, I will go back to our US listing, which is on the New York Stock Exchange. Okay, so let's start. Share count is 937 million, which can be found here, 937 million. But you need to know they did a 20-to-1 consolidation, so divided by 20. So that's what I did, divided by 20, share price 12.2, so market cap is 572, which is almost the same as here. 500 million company, okay. What are the liabilities and assets? So as always, I use the current assets only. These properties here, I assign no value to that because you need to be able to sell it. At the end of the life, they will go to zero. So I only look at the current assets, which is 338 million. So that's the 338 million here. Liabilities, I always take all the liabilities just to be conservative, and you should do that as well. 3 billion. This is a huge amount of debt. 3 billion in liabilities. I added that here as well. 3 billion in liabilities. So that gives me an enterprise value of 3.5 billion. Now they said in the presentation it's only 2.5 billion enterprise value. So why is there a gap of 1 billion? Probably they don't take into account some items like asset retirement obligations, which is, who is going to pay that? Someone needs to pay these obligations. So yeah, that should be counted as well. Other liabilities. So you need to add everything here. Of course, this is from June. they could have made some money, and this is from September. But anyway, I'm taking the June numbers at the present time. Market cap was 1 billion at the time of September, and then it crashed to 600 million. Okay, so that's the situation. We have the enterprise value, and we have the share count and the market cap. Okay, so let's continue. Let's take a look at capex. What capex do we have? Normally, you should be able to find that in the financial statements under where is it? Under the cash flows. Investing activities. So what do we have here? Yeah, the acquisitions, not sure we will add that. Yeah, this is important, 30 million. Disposals. So this is the most important, 33 million per half a year. That gives us 60 million. Last year it was 80 million. Now it's 60 million. So we can use this number. Also know they did an acquisition, so that could change it a bit. But let's use 70 million, should be a good number for the capex. We will verify that. SG&A can be found in the income. SG&A general and administrative expense. We are not taking into account these financial instruments yet. Okay, so 6 months, 55 million US dollars. Times 2 is 110 million. Last year it was a bit higher. Now it's a bit lower. Not sure why, but it's lower. So 110 million. Let's draw this like this. We are just creating an NPV flowchart based on the current situation. So in the future, they could do acquisitions. I see that they like to do acquisitions, but currently we just look at the current situation. So interest, that's an interesting one because they have a lot of debt. So let's see what the interest payments are. Finance costs of 67 million. Also, the asset retirement obligation accretion needs to be counted in because that's going to be added as well. So we have 78 80 million. 80 million half a year, so 160 million per year. 160 million per year. Those are big numbers, very big numbers. I think they will pay it down, but let's just do it like this now. 160 million interest payments. I recently also added depreciation, so minus depreciation for the tax and then plus again. So maybe we can find the depreciation here. About 115 million times 2 is 230 million. Let's do this as well. Okay. Then tax rate. So what's the tax rate here? Income before taxation, and then we have income tax. 197 divided by 828. 23.8. Okay, 23.8. What was it last year? They got tax benefits last year. Interesting. Yeah, not sure why that is. Oh, they had losses, of course. So let's take 23.8 based on these numbers. That's the tax rate, which we can also put here. Royalties. What are the royalties? I don't see any royalties here, which is weird. I only see revenue, operating expense. Interesting. Yeah, no royalties. So I can't use any of those numbers. Maybe I can find other data here. Okay, so we have the basics of the balance sheet. Now we look at the latest quarter. So we got third quarter results. Do we have anything else than the third quarter? They did a sale of assets. Yeah, we only have third quarter results, so let's look at the third quarter results. Daily production. 134,000 BOEs per day for September, right? 134,000 BOEs. Not sure if this is 1,000 or million. Let's use 1,000 first. Decline rate of 10% is actually very good. So this is a long life asset. Typically in Canada, you have 20-30% decline rates. This is actually a good asset. 22% free cash flow yield, but that was September. Very important, that was September. Let's see what we have. Realized price is 20.75 in September. So that was September revenue per BOE. Then we have the costs, operating expense, 8.24. Employees, administrative costs, and professional fees. Not sure if that's added in here. This is about 4 times, and this is also about 4 times. Yeah, so we need to calculate this. $8.24 per BOE. So let's look. 8.24 per BOE, and they produced 135,000 BOEs per day. Per day. So this times 92, or yeah, 92 for the quarter. That's per day, that's per quarter. That's the amount of barrels that they produced. Yes, based on this. And this is the cost. So costs per barrel. So we need to do this times this. Will give us the costs. Yeah, this is 6 months ended, so need to do times 2 as well. So 203, yeah, it looks almost the same, but yeah, this was Q3. Let's look at Q2 actually, and Q1. Q1 we had 139 production, almost the same, 134, 139. And what was Q2? First quarter. Yeah, this is for the 6 months, so it was 142, which is higher than this. 142, remove the 2, of course. Yeah, actually 142. And we have 215,000 costs. Yeah, that's almost the same. So general and administrative should be added on top of that, right? Because this is much higher. Okay, where were we? Let's get back to here. 8.24. Let's add this one. 9.81. 9.81. Then we have 256. Yeah, this is of course for the third quarter. For ease of the situation, use this as operating costs. Okay, and then we add the administration on top of that. Yep. Okay, let's use conservative numbers. 9.81. So that's the operating cost currently. Right? 9.81 and 20 revenue. That's actually not a great margin. I have seen companies with better margins, 20 and 10. Yeah, you get 20 and you only get half of it. So not that great. Too many expenses. And as you can see here per BOE, it's much lower than the oil price. So that means this is probably a gas company. Let's see where the production is. And actually, 134,000 is correct. Right, because we used 134,000. And yeah, that's per day. So if we do 1,000 on this, then we actually get per quarter this amount of production times the costs, and this is the number. And you can see here, this is 256 million, which is this number. So it's in thousands. So this number is correct, 134,000 BOEs per day. Now, how much of that is natural gas? Looks like this is a natural gas company. Where do I see the breakdown? I don't find it here. So where can I find it? No, they don't give anything. They just give me the price and the costs. That's all they give, and nothing else. Yeah, making it very difficult. Canadian oil companies give much more information. Okay. Let's look at the presentation then. So they're in the USA. That means they probably get US natural gas prices, which is currently cratering 2.5. In Appalachia. Yeah, Appalachia is a region where natural gas is going to be flat in production. Let's see. Okay, so 86% natural gas. That's very high. So they are basically just a natural gas producer. Reserves 850 million BOE, 850 million BOE, right? And they produce 50 million. So what's the life of mine? Probably more than 10 years. Daily production 134, okay. That's the 134 here. 1000 BOEs. Large amount of debt. You already know that. And they did a lot of acquisitions, so probably more acquisitions, but lately there's only one acquisition and good decline rates of 10%. Okay, we know it, 134 production. Margins are indeed 50%, which is actually not that great. Good declines. A lot of that. Okay, production, 86% gas. We can use these numbers. So 86% is this times 86%. Yeah, that's for the, yeah, this is natural gas liquids, which is 11%. Then natural gas is this times 86%. And oil is 3%. So this is our composition. Not sure which price they will get. We will see. So 20.75. Which is this number. Yeah, they have been increasing production, primarily gas and paying dividends. Okay, here we can see which price they are getting. So they get Henry Hub apparently, which is currently at 2.55. It doesn't even go on my scale, which is a problem. Yeah, interesting. We need to decrease our scale 1.5 to until 7. Yeah, gas prices were a bit higher last year, but that has changed. So now we are at 2.5. So let's use this line. Oil price. Yeah, oil price is 73. Yeah, this needs to be rescaled as well. Oil prices are lower. Natural gas liquids. You can use this site, which is 30.61. Rescale as well. Energy prices have definitely come down. So now we have our current prices for this company. Using these things here, we can calculate free cash flow. Look at the formula. We use E6 times L4. That's natural gas liquids, right? Per BOE. The revenue from natural gas liquids plus the revenue from nat gas. That's this one. And this is per MCF. Plus E8. That is oil price using this. Minus cost and production in BOE. Then we deduct capex and SG&A and add a tax with a 5 multiple. Now I want to check one thing. The natural gas revenue. Is this going to be E7 times J4? That's per MCF. That's per MCF. but I don't think that these BOEs are per MCF. Let's see how I did that for another company. Long time favorite, Pure Day Energy. So here we took E7 net gas production times the net gas price per MCF. Yeah. The question is, I think this was the production per BOE. So what is the production now per BOE? That's important. This is not the MCF, the amount of MCF that they produced. This is the BOE that they produced. Okay. So we need to convert this to MCF somehow, which is just divided by 6 probably to go from BOE to MCF. But let's calculate that. See, you can see it here already. So if you have 136,000 BOE, if you do it times 6, you get 814 MMCF, million cubic feet. So let's see, 136 times 6 is 816. Yeah, that's this. Okay. So we need to do something here. So this is the price per MCF. How do we do this? Because this is BOEs. And probably, yeah, one of these needs to be changed. I'm not going to change the gas price, of course. So I need to change this number, right? The question is, do I do this times 6 or divided by 6? That's the question. So how do we check this? 400, this is an easy way. 400 million revenue, okay? 400 million revenue times 2 is about 1 billion. 1 billion revenue per year. we need to have about 100 billion per year. So let's say I did this. This is per year times 3. How much do I get? 126 million. That's not a lot. 126 million. Right? So probably this needs to be times 6. And then we get almost 1 billion. Yes? Yeah, I think this should look better. Yeah, the thing is, this is in BOE and then this is in MCF, so there's a bit of brain things going on. But looking at the revenue, this should be indeed around 1 billion. Now, what was the gas price in June? Yeah, around it was around 3 to 2, 2 to 2 to 2.5. So using 2.5 gas price times the net gas production, we get about almost 1 billion. They probably hedged some of that gas at higher prices. So I'm pretty comfortable with this number. So this is the production mix. Yeah, this is natural gas liquids, 11%. You can do that in BOE in this case because this is in barrels. Okay, so this is already in barrels. But natural gas is quoted in MCFs or MMBTU, which is 6 times lower. So that's why this needs to be 6 times higher. Okay. So next up, let's see what we got else. NYMEX was 6.6 last year, 2022. Let's see. Yeah, that's around 6.6. And what's this? Net debt to EBITDA. As the price of gas goes down, Yeah, the EBITDA goes down as well. So this goes up. That's the peer average. But the diversified one is pretty stable because of the hedging strategy. Yeah, they do have a lot of hedging. Some have no hedging, some have a lot of hedging. Diversified one has 85% hedged. Okay, that's good to know. Apparently at 3.5. So if we use 3.5 times production, we got the 900 million. Plus, of course, these things here, plus this times this, and plus this times this. So if you add it all up, you get 1 billion. Yes, above 1 billion. So that's probably the same as this one. So yeah, we're getting there. Last year they got even 2 billion in revenue. Why 2 billion? Because last year, yeah, the price was much higher, 6.6 instead of 3.5. So almost a double, and they have a lot of natural gas. So that's why the revenue is double. So they are hedged, 70 to 90% hedged. That's a lot. So there's less risk of commodity prices, natural gas prices, and 50 to 70% hedged over longer term. Yeah. So if you're looking for great leverage to natural gas, up or down, this is not the play because they are hedged, which could be good or bad. Okay, so we have some capex numbers here, 86. 86 capex, let's see. Yeah, 70. Let's make it 80. Costs are going up, so let's make it 80. Then some interest, income tax. Yeah, that's 2022. They had a lot of cash flow in 2022. About 250 million. Today, however, what's the cash flow? Yeah, actually also 250 million. Yeah. This is coming from here. This whole calculation. Oh, SG&A is not added yet. So SG&A, 110 million. Okay. Interest is also not added yet, which is 160 million. Royalty, I didn't see any royalty, so that's 0. Okay, so everything is filled in. What do we get now? Only 50 million free cash flow. Why is this here? Okay, so now it's 50 million. It was 250 million in 2022, but that's probably because the gas price was like $6 or 3.5, like you said. Yeah, 250 million indeed. But now the gas price is lower. Okay, they do have some hedges, but hedges will eventually come off. So about 50 to 100 million free cash flow per year. That's the estimate. At this price, we have more cash flow. That's for the second half. So at this point, this is still going to be pretty okay, 250 million. But you need to know natural gas is not at 3.5 now, it's lower. So if this stays at $2 for a long time, like for more than 2 years, okay, then the hedges will come off. The hedges will come off and will slowly go to $2.8. But for now, yeah, for now it's still cash flowing at 250. But if it goes to 2.8, then it goes to 100. So take that into account. So which price should we use now? That's a difficult one. It depends on, yeah, it should be 3.5 now, because that's the price that we find here, 3.5. But this could come down to 3. So for now, I would use this price. And actually, this is the blended price, 20.75 per BOE. Yeah, that's the blended price per BOE divided by 6 is 3.5. So 3.45 actually is the latest price. Yeah, with 230 million cash flow per year. Is this a good valuation or not? Well, I don't think so. This is not a good valuation. Enterprise value 3.5 and 5 times free cash flow is only 1 billion. So that's overvalued. This is overvalued. Fair value would be somewhere here. But this is clearly overvalued, with gas prices coming down to 3 in the coming years, the market cap will need to drop because this is overvalued. So you already see where I'm going. Okay, so net back is revenue minus costs. Half net back, also not good. This is going to come down. Okay, so let's try to fill in this production BOE. That's this per year. I don't know yet how the production will increase. Let's say it's stable. Okay. We have everything filled in. So normally this, yeah, the price per BOE is not 74, it's 20.75. That's the blended price per BOE. In US dollars, capex, and then we have around 150 million income. Why is it 200 here? Not sure, maybe the depreciation has something to do with it. But that's not even worse. Not sure. 9.8. I use the same numbers here. Yeah, 1 billion of revenue and minus C44, which is half of it. Minus C50 SG&A, yeah. C52 depreciation, which is added later on. 1 minus C53, tax rate 24. And then minus interests and capex. Yeah, here I taxed this thing here. But here above I taxed at the end. So that's the difference. Should you tax also the capex and the interest payments? Not sure, but these are two different ways of calculating it. Okay. So here we tax the EBITDA and then subtract the capex. And free cash flow is about 150 million. Okay. $3.45, yes. So yeah, I don't see any mistakes here. Capex 80 million. Okay. So it's around 150 million and here it says 200 million. I mean, these things can change really quickly with, if this goes to 3, then we already have 150 million. So, yeah. Good. Production, yeah. Okay. Now let's look at how this is going to change in function of time. So you can see already here, this is not really an undervalued company. This is actually overvalued. And that's a problem. Now they get 150 million in income per year and have a debt of around 2 billion, as you can see here. They do have a lot of debts, 1.5 billion. It will take a lot of years to pay off 1.5 billion. If you only have 200 million, 150 million in cash flow, right? It will take 10 years, I think. Let's see if they have anything about the debt. Yeah, revenues around 1 billion. Realized price is higher because of the hedging. We know that. Cost 1.6 per MCF. If you do this times 6, then we have indeed the $10 cost per BOE. Not sure how they even can give a dividend because they need to pay off debt. And their cash flow is not that great. Cash flow of 25, EV to free cash flow, that's not a lot. That's not good. We do see the costs going down a bit, but it's not spectacular. Here you can see the acquisitions that they did. Probably will add some revenue at some point, but it will take time. Did an acquisition in 2023. Yep. This is what they acquired, 250 million. Okay. 17, that's not that high. So yeah, they did one acquisition. A lot of undeveloped locations that they can add. That's good. So if you are a long-term investor, there could be upside in production. some joint venture. Yeah, there's a lot of data here. Too difficult to understand. You need to be an engineer for that. Okay, so we know it's 85% hedged. So as of this, 85% hedged. Take that into account. Then, actually, we are already in 2024. It's 80% hedged now, and then 70%. And here it's 70% hedged, which is still good. And the price will actually be around 3.3. This is going down. Okay. So I'll take that into account. This price here, 20.8, it's going to come down. Could be 19, 18. I can't look that far in the future. Natural gas. What's the natural gas price going to do? We can just look at this. This is my go-to website. You can see that natural gas prices will come down this year to 2.3 and then go back up to 3. So it's not going to be above 3 for this year. So if they hedge at 3.8, 3.3, the price is going to be lower than this. So take that into account. It's not going to be above the hedge price. Of course, in 2025-6, you would get the LNG plants online, and that could spike the gas price beyond 2025-6, 7. So it's possible. I can't see the future. If those LNG plants come online, the price could go to 4, 5. So that's the bet here. If it goes to 4, 5, then you could see instead of 3.5 gas, you could actually see $4, 4.5. So let's say LNG comes online here, right? So this is pretty awkward, this. But let's say LNG comes online in 2026 and we get 25, right? That's possible. 25, 28. And let's say that this will be the long-term price for a while, because we have LNG plants and the price will go up of natural gas to the Dutch natural gas price, which is higher at $10 per MCF, and LNG is also at 10, Turkish gas also at 10. So you could see the price go up in the future with those LNG plants, and then you actually have a much better situation here. Of course, this chart needs to be extrapolated. They still have a lot of growth. Then it would be a pretty good buy, fair value. if you believe that natural gas will go up in price. But at the current gas price at 20, you could see that, yeah, it doesn't look anything interesting to look at. But I do believe there is chance that we could see 25. That's about 20% higher than the 3.5. Yeah, that's above $4 of natural gas. Is possible. Okay. So I could do this. And it's not that bad, this company. If we use a price that's 20% higher. So 20% higher would be 4.2. Then it looks better. This is a normal valuation to me. Most oil and gas companies are around this level, 7-8 times free cash flow. So this is 5 times EV to free cash flow. This is 7 times EV to free cash flows. Okay, so this number is 5 times, and then this is a bit higher, 7 to 8 times, which is a normal valuation. So if you're long-term and believe natural gas goes up, I think this is fair value. However, if natural gas stays at current levels, this number will come down, and we could even see lower valuations. So yeah, this is a very dangerous company, very dangerous to me. It all depends on the natural gas price. So keep that in mind. Here you can even see the derivative contracts. Just use this 80%, 70% hedged. Looks conservative around the $3 level. Natural gas liquids also hedged 60-40, oil 40, but this is not that important. What's more important is the natural gas price, because that's where all the revenue is coming from. Yeah, this is the cost coming down. That's good. Maybe the cost can go down even more. It's 9.8 now. With transportation, etc. 9.8. Maybe they can increase the efficiency. Let's say 9.75, 9.7. Not sure how much they could reduce it. I don't think that will change a lot. It's mainly the natural gas price that will give this a good or a bad valuation. Okay, so here they talk about the debt. Okay, as you can see here, the debt is going to be paid back apparently in 7 years. Yeah, in 7 years, the debt will be gone. So I could depreciate this interest in 7 years, if I believe the numbers. Let's try this. Yeah, that's 1, 2, 3, 4, 5, 6, 7. So it's about this. then the chart becomes even better. Actually, now it doesn't look that bad anymore. If you believe gas goes up, interest gets paid back, debt gets paid back, then this is still buyable actually, but still overvalued, but buyable. Okay, so these are the principal payments, and it will go down in 10 years. If everything goes well, of course, if natural gas goes down, then they will not be able to pay off debts. That would be a problem. Emissions, okay. And these are the financial statements. We looked at that. Assets, take into account the 3 billion in liabilities. Someone needs to pay this at the end. Okay, these are not going to be needed to be paid right now, but at the end of the life, someone needs to pay it. And that's where the enterprise value comes from. Cash flows, we know the capex, okay? They have no guidance on how the capex will go, but let's say that it's always the same. Okay. This is natural gas production. That's per day, 142 per day. Production is actually rising. Yeah, 145, 138. But lately it's 134. So back down. Not sure why, but it's back down. Okay. Yeah, that's the revenue, and these are the expenses. Okay. Now, there's one last thing that we need to look at, and that's this here, the asset sale. So what did they do? Apparently, they reduced the debt by 12% by selling something for 200 million. Okay. So actually we can reduce the debt already by 200 million. Actually not 200 million, because they also sold 80% of this special purpose vehicle for 30 million. Which means they own 20% of that special purpose vehicle. But it's 200 million. Yeah. So they sold, let's look at it again. The sale of producing assets to a special purpose vehicle, and they retained 20% interest in the assets. They got 200 million, but they sold indeed 80% of that asset. Yeah, the 200 million is comprised of the SPV and a sale of 80% equity interest. Yeah. So what we can do is reduce it by 170 million, which is probably 12% reduction in debt. 170 million. So what was the debt again? The debt was 1.5 billion. 1.5 billion. What's 12% of 1.5? That's 180 million. So indeed, they reduced it by 180 million, the net debt. So what I can do is already, because they sold something, then here we can already do minus 100. Yeah, 170 million. Okay, because that's a reduction in debt. Because of this asset sale. So the balance sheet has improved a bit. Okay. Not sure how this will affect the cash flows, but that's done. Yeah, also interest needs to be a bit lower, of course, by 10%. Because there's 10% less debt. So 90% then. Yeah, then this will probably also go down faster. I'm really nitpicking right now. It's not going down much faster. Yeah, let's say that they could repay it here already. Okay. So this is the end situation. Taking into account all the different variables that are possible. Net gas going higher in price when LNG comes online. Probably $4. Why $4? Because we do have TTF gas currently at $30. So natural gas is somewhere here, US natural gas. So I think these two will converge together probably around $4. Yeah, this is in euro per megawatt hours. So we need to do this divided by 3, I guess. Yeah, this should be around $10. Yeah, 10 and then 2, and then they will converge at 4. Okay. So that's how I come to this price evolution. Only sustaining costs were going down over time, not that much. Production, yeah, production. I don't know what production will do. They don't tell me. Yeah, there's no mention of how the production will grow, but they do a lot of acquisitions. But it's not like their production is actually growing through drilling. It's more like acquisitions. So not sure how I should model that. I don't think they can drill that many wells. They do have debt to repay. So not a lot of capex expansion possible. Yeah, they don't tell me what the growth rate is. So I can't say anything about that. Basically, I've kept it stable. That's also something to speculate on, right? How is the production going to increase without acquisitions? So yeah, that one I don't know. Costs, yeah, we're going to go down. Tax rate, yeah, around that level. Depreciation, yeah, that's this year, 200 million. Actually, what happens if I delete this? Oh, okay. It helps in the taxes. And then we have the net income. Yeah, why is this lower? Because I reduced the price of natural gas a bit. We know that it's going to go down this year, and then it will go back up when LNG comes online. So that's it. We have actually an EV to free cash flow here, possibly at 10, 9, but currently at much higher, 20. And here we have, yeah, depending on the natural gas price, it could easily go to an EV to free cash flow of above 10 or below 10. So it's all dependent on the natural gas price. So play with this Excel. You can use any other number. If you use 90 oil, doesn't do anything to the cash flows. Natural gas liquids, even if it doubles. Oh, actually it does do something. Natural gas liquids do have some leverage to the free cash flow, but mainly the gas price. If we go to 5, this is going to be very profitable. I could see this enterprise value go to here. That's about 1 billion increase in market cap. So plenty of upsides. 1 billion increase in market cap from the current market cap of 5, that's a triple. If gas goes up to $5, that is. Okay. So a lot of leverage to the natural gas price. CapEx, let's see if they reduce all the CapEx. It's not going to change anything to this curve. Okay. It's low CapEx. They're just going to keep on producing and reducing debt. SG&A the same. Interest payments, if all the interest is paid off, there could be some upside. Yeah, that's an upside of 1 billion, almost 1 billion. That's good because that means the market cap will go up by 1 billion. And that's almost a double. That's a double just by paying off the debt in 10 years. So you could get a double in 10 years just by paying off the debt. That's interesting. Low decline, so long life assets. So I think that was it. Oh, discount rate, we can also play with this. Let's say we have 5% discount rate, then it's actually fair value. 0% discount rate. These are the actual cash flows, undiscounted, which is actually very good. You see that there's upsides. But of course, we live in a world where there are interest rates, and we need to add a discount to that. Because you could just put your money into a bond at 5% or loan it out at 10%. So there must be some discount to the cash flows. But all in all, yeah, I think this company is, I wouldn't buy it. I would actually wait until natural gas will bottom out first. Maybe next year, if LNG comes online, then you can start buying it. But currently, it's still overvalued at the current gas price. So yeah, that's the thing here. And this is, if you buy this company, you're just buying the natural gas price, basically. Which is not bad if you think that natural gas is going to go up in a few years, then you should buy it. It is a profitable company. You can see they do have 100 million in income currently. Here even 200 million, so it's about 150-ish, 150 to 200 million income, which is not bad. Technically, it's a PE of 5, right? Because the market cap is 500. So that's a PE of 5, but EV to free cash flow is 20, going to maybe 10. So when you add all the debt and asset retirement obligations, it's overvalued to me. And this is why the company has underperformed that much, because it's highly leveraged to gas and has a lot of debt. That's the problem. So yeah, I would not buy it. I would wait a bit until we are pretty sure that natural gas has bottomed out, and it hasn't bottomed out yet. I think it's still going to go to here for this year, and maybe bottom out next year. We will see about that. Yeah, but it's really not looking good yet. So somewhere here, I would start to buy. Okay, so that was the video about diversified energy, and I hope you liked it. I'll see you in the next video. Bye.